Happy New Year, everyone, and welcome back to Vox Markets. My name is Paul Hill, and I'm delighted today to be able to host this exclusive macro investing masterclass covering the global economy, bonds, equities, with three of the sharpest minds in the city, namely James Bevan, Chief Investment Officer of CCLA. We've got Colin, McLean, CIO of SVM Asset Managers, and James Athey, Senior Investment Manager of Aberdeen Standard Life. So welcome, gents.
Good morning. Happy New Year.
Happy New Year.
Happy New Year.
2020 undoubtedly goes down as an unprecedented year on numerous fronts, not only on the pandemic, but also on the sort of the huge amounts of fiscal and monetary stimulus, and then the superhuman efforts by our scientists to develop an effective vaccine in less than 10 months. But looking forward, obviously, that's how the markets sort of price themselves. How will the next 12 months pan out in terms of the economy? I don't know if you want to start off this one with James B.
Well, absolutely. I'm very happy to talk about these issues. I mean, it seems to me that the first thing we've got to do is to look exactly where we have got to. What I find fascinating is that the first quarter of the United States GDP record was down 5%, the real action being in Q2, a decline of 31.4%. But then this very sharp recovery that occurred between May and October, where real growth picked up 33.4%. Delivering, therefore, the sort of V-shaped recovery that many had doubted could be achieved. What I find interesting is that November's data looked very strong. The Atlanta Fed's GDP Now model presently tracking GDP growth in the fourth quarter of 10.4%. And that suggests to me that the economy is on track for faster growth in the first half of this year than many had predicted. And I think that that will lead through to reasonably strong corporate earnings growth, because of course, as equity investors, that's what we're interested in. In terms of the hard numbers, I would see S&P 500 forward revenues per share sharing this V-shaped recovery. I'm expecting growth of about 8% in the current year and 7% in 2022. That would allow me to project something in the order of $140 2020's earnings per share for the S&P 500, followed by about $170 for 2021, and then a heady $195 in 2022. Now, those of you quick on the maths will recognize that I am talking about margin expansion, and a big part of the bull case for equities is now looking for capital expenditure to improve productivity. So productivity and central bank policy are going to be the keeping a very close eye on in the year ahead.
And just on those maths, I mean, where does that put the sort of the forward PE ratio for the S&P 500 for 2022?
Well, I'm assuming, you see, that the bonds yield stays low, and therefore we can have a price earnings multiple well north of 20 times, so 5% earnings yield. And on that basis, I think that we could see the S&P 500 get to around 4,500 points by the end of the year.
Right, end of 2021.
Correct.
Okay. Does anybody else have a different view, or is everybody still bullish, even in light of the new COVID strain? I don't know if you want to have a go at this one, Colin.
I'm pretty bullish. You look at much more at the UK and European markets, but I think there's the potential for quite a sharp recovery, not least in the UK with Brexit sorted. I think overall in the mature markets, there's quite a lot of inventory rebuilding needed. So I think there's quite a lot of pent-up demand there. And a lot of the economy has actually fared quite well. Many people in the public sector, in professions, have carried on earning through this lockdown period. So the accumulated savings, are something that is there to be spent. And I think that means a real desire for travel, holidays, and picking life up again as the year progresses.
We've all got cabin fever.
Yes, I think we've all bought as many barbecues, fire pits, puppies, and so on.
Yeah, coffee making machines, bread making machines at home. Yeah. So James A, if we're going to see a strong economic rebound next year, regardless of the sort of the short term sort of like darker outlook on the new strain. What's that mean for the bond markets? Because would that sort of like increase inflation expectations and therefore steepen the yield curve, or what's your view?
Yeah, I mean, that's the kind of $64,000 question. I mean, I'm the resident bond guy, it seems, on this panel, so I have to be a bit more miserable and dour than the equity guys. That's just the nature of the market I'm in. So I'm a bit more circumspect on the economic outlook. I think what we've seen is sequential recovery because government policy was to close parts of the economy, and the mechanical reopening will mechanically shift GDP back towards levels that existed previously. But what we see is still very elevated unemployment, and actually even the unemployment picture using headline measures is probably overstating the extent to which companies are behaving in a pro-cyclical manner. So to agree with James B, I do think CapEx is going to be massively important. Actually, if you look historically, as much as consumption is the vast majority of most Western economies, it is CapEx which marks the turning point in cycles, because you have a small contribution to GDP, but massive changes in that small contribution. So our business is going to be acting pro-cyclically in 2021. I guess that depends which sector you look at. So I'm a bit more circumspect on the economic outlook. What does it mean for bonds? Well, I think we've already mentioned the magical or dirty word, depending on how you're positioned, and that is inflation. What are the chances that all of this money which has been thrown into the system is going to be pushing prices up in a way really that we haven't seen for a number of years? And to me, that's the most important question, but actually a really difficult one. I still think disinflationary forces will dominate, certainly in the near term, but I do think there are some technical influences on inflation which could give us an inflation kind of shock sometime around the middle of the year, possibly from the end of Q1, where things like base effects and some supply side destruction will start to push prices up, and markets could struggle to adapt to that, even if it's not inflation which is self-sustaining. Wages are going to be key for a self-sustaining inflationary environment. So complicated. I think we could see an inflation shock. I still think duration has value here. I think the rumours of the death of duration as an efficient portfolio hedge have been greatly exaggerated. But I think one needs to be careful. So I do like hedging duration with steepeners where possible.
We're just talking on just top level inflation. I mean, we've certainly seen asset price inflation. I mean, the central bank actions have just absolutely had a huge correlation between sort of like equities and bonds. And just top level, James A, how much has the central bank sort of brought down the yield curve? What are they, just as an indication, is it 1%, 2%? I mean, when you see Greece on a 10-year bond of 0.6%, I mean, that is just, I remember when they were 35% at 10 years ago.
Yeah, absolutely. I mean, the central bank has been very successful in doing a few things, none of which are its stated aims or its legal mandates, but it's certainly sucking the appearance of risk out of the system is something that it's been very successful at. And as you've already noted, defining inflation somewhat differently or more broadly from consumer price inflation, they've been very good at creating inflation. If I were to describe inflation as a generalized rise in the level of prices or a reduction in the purchasing power of currency, they've been relatively successful, and I think increasingly successful in recent years. I would argue that's something that one needs to be very careful of. So yeah, you're talking about the concept of term premium. I don't like it. It's a remainder. It doesn't really have any theoretical underpinnings, but definitely it is calculated as being a negative number, suggesting that central banks have been very successful at suppressing yields and engaging in financial repression.
And can they go up? Can bonds go up from here? I mean,
well, it's difficult because what we've done is we've created a system which is highly levered. So they've used monetary policy as the first tool to deal with all economic weakness of any nature, be it cyclical, be it structural, be it very transitory. And in doing so, they've encouraged more and more debt. And so you have a more and more interest rate sensitive financial system and economy. We saw in 2018, even when the US was posting relatively strong growth numbers and had been for a considerable period of time, when the punch bowl was just taken away that little bit too quickly, it wasn't the economy which dipped or dived, it was equity markets, and it was the Fed responding to the equity market decline that saw them actually giving back that stimulus. So it will be very, very difficult for central banks to extricate themselves from this massive, massive hole they've dug for themselves.
Yeah, James B, just on the yield curve, US yield curve here. If we've got a really strong US economy next year, will we see the 10-year Treasury go above 1%? I mean, it seems as though direction of travel is higher.
If we just talk about the level of central bank support in the last year alone, I can look at $7.4 trillion now as the Federal Reserve's balance sheet. They've increased it by $3.3 trillion in a single year. The European Central Bank balance sheet's $8.5 trillion, up $3.3 trillion. The Bank of Japan's balance sheet is $6.9 trillion. That's up $1.7 trillion. If you combine the three, we get to a grand total of $22.8 trillion. That's a gain of $8.3 trillion over the year. If you said, where would bond yields be if we did not have this central bank buying, I think that we would be talking about a US 10-year yield at around 2%. And I'm gauging that yield by looking at the relationship between the copper price and the gold price. And ordinarily, the relationship between the pricing of those two metals gives a fair indication of where the bond yield should be. And as I say, if you were to use a regression analysis, you were simply to look at the past patterns of the price performance and relative positioning, that would suggest the US 10-year bond yield should currently be at 2%.
Right, and what about the US? Sorry, the UK sort of like 10-year. I mean, that's the 10-year for sort of the, you know, for the US has driven bank stocks very high with the anticipation that the yield is going to be, you know, steepening. What about sort of the UK sort of the yield curve? Is that going to stay at still the 10 years still going to stay at about, was it 0.2%? I mean, James A, what's your view?
Yeah, I think right here there's an awful lot priced. I think you really have to believe that the Bank of England is going to cut rates again or engage in further QE expansion to want to own 10-year gilts. I mean, they were 15 basis points when I first looked this morning, so even richer. There's been a heck of a lot going on in the UK with obviously the COVID situation worsening significantly, but also Brexit and that saga dragging on for the last 4 years, seeing some resolution on Christmas Eve, but actually the reality dawning that this is really the beginning of a process which will continue. So I do think that the UK has a challenge near-term outlook. I do think a lot of that is in the price. I think I'd rather be a seller of gilts than a buyer right here. Right.
Okay. So in that environment, Colin, how are you positioning your sort of your stock portfolio? Because if we're going to have ultra cheap money in the UK and you've got a steepening yield curve in the US, but still say relatively low in historical terms, I mean, how do you see the sort of the equities and which areas you're going to stay long technology and platform, or are you going to sort of like move into sort of like more rotational cyclical plays?
I think there's sense in moving a bit more into rotational plays. I mean, we're seeing at the start of the year just now new highs in stocks and copper, good moves in oils as well as in mining. What we haven't seen so much just of late is a real follow through on banks. And I don't think it matters so much what target inflation we get to. I think the bank equities have been influenced quite a bit by fears of negative rates and all the Bank of England talk of late last year. And I think just that disappearing, realizing that we're not traveling to that anymore, suddenly makes the banks look a bit better.
Yeah.
And that steepening of the yield curve, I think, along with generally an underinvestment in UK PLC by international investors. So I think we'll see a more generalized pickup in value, I would think, this year.
Yeah. I mean, and just looking at the sort of the difference on the FTSE 100, I think you own one of the top sort of two, which was OCDO, I think, has been one of the top performing shares. And then the bottom have just been obviously the oil stocks, the bank stocks, airlines, cruise ships, anything to do with the sort of economy. Just as a broad picture, how would you, if you see that, is it likely to be that mean reversion trade going forward then next year? Yeah.
I think what people should remember too is a whole lot of M&A activity, all the mergers and so on, have been held back a bit by this uncertainty on Brexit and perhaps concern on COVID. And we've opened the year with the former GVC Entain bid for, that follows the William Hill bid. I think there's a big pent-up demand, perhaps surprisingly, not so much for those with big UK exposure, but UK listed companies with US exposure. we're seeing some announcement from Ferguson as well with its big US exposure too. So I think some of the UK listeds with international exposure might start to look quite attractive to international investors, particularly to corporates for M&A.
Yeah, and James B, what's your sort of top level equity strategy going forward? I mean, you've got some world class companies which have done really well, the likes of Amazon, etc. But I guess you don't own any Tesla or Bitcoin or any of the EV stocks.
Well, I think it is incredibly difficult to see who are going to be the winners in the automobile market, for example. And I absolutely believe that cryptocurrencies are now a speculation rather than an investment. But accepting that I am going to stick with quality and secular growth, given the uncertainties for the global economy, looking at the UK domestic economy, and I would welcome Colin's view on this, I do think the house builders look remarkably well placed. If it is the case that the pocketbook of the household is relatively rich, employment prospects are beginning to improve, central banking will remain supportive, fiscal policy will remain accommodative, I do think that house builders, the likes of Barratt Development, Bellway, will have a further day in the sun and look structurally cheap. Colin, what's your take on that?
I think you're right, James. I would very much agree with that. I suspect they correlate very closely with some of the domestic banks as well, but I think house builders should pick up. We're structurally short in housing in the UK, and I think there'll still be the same demand. We're seeing it certainly overall in the housing market, quite strong pricing. So I think house builders, you're quite right, are one of the opportunities for this year.
One idea you might want to run your slide rule over, James B, is Taylor Wimpey. And the only reason why I mention it, if you're looking for house builders, then it makes houses sort of 4 to 6 bedroom houses. So people come out the city and want a nice sort of garden and a bit extra space for their home office. Then Taylor Wimpey should be right in that space. But I'm with you. They're still trading at around about 1.3, 1.4 times book, and in historical terms, if you look at it compared to the US, if you look at a mean reversion trade, then they're significantly cheaper than any of the US house builders. James A, in terms of if there is a strong housing market, have you had a look at the sort of the mortgage-backed securities at all, or is that sort of like still sort of they're well bid? The price of those yield on mortgage-backed securities is still pretty tight.
Yeah, looking for value in financial markets full stop is difficult, but I think you can find pockets of the equity market globally and sectorally where you can very well argue that there is some value still left on the table. It's a bit more difficult in fixed income. Everything has been compressed, but the risk-free rate is essentially zero everywhere, and that's just compressed term premium and spread. Of course, if you're buying US mortgage-backed securities, a lot of those are being bought still by the Fed, and so you do still have that backstop bid. But really, I think what you're talking about is just picking up carry in the meantime. I don't necessarily see that there's a huge amount of spread compression left in some of those positions. The US housing market, yes, it has been hot. I do wonder if we're likely to see a sort of reversion to the mean again in terms of activity. I think we've seen it in the UK also, where there's been a flurry in the immediate aftermath of the pandemic striking and all of the economic damage and policy responses that engendered. But maybe that's not something which we can continue to see increasing at the same pace. And so I think maybe we'll see some housing activity ameliorating in this, later through this year. So mortgages is probably not something I would see as being a hugely attractive risk reward right here.
Yeah, given that the ultra low interest rates has pushed up a few sort of asset bubbles, but it takes quite a long time for some of these bubbles to go pop. As we've seen that with Bitcoin and with Tesla. But if any sort of investors hold these very popular shares, or even in sort of like on the fixed income side, when you sort of identify a bubble, what's the sort of rule of thumb that people use in terms of when to sell these, given that they've ridden up so much, like Tesla's 700%, we've got NIO, we've got Nikola, we've got all kinds of stuff. I don't know if you want to take that one, James. James B, how do you sort of like gauge if it is a bit of a speculative bubble stock? When would you start sort of taking back your position? Is it on value basis, or is it just you ride the momentum as long as you can?
It's very interesting. The tactical indicators are much more capable of describing forward movements when markets are very depressed. So there are reasonably reliable indicators in the depths of bear markets when one should begin to be prepared to commit money back to markets. There's relatively little hard science as to when bubbles begin to deflate. Typically, we need to see a trigger. I think that the big trigger, if we were to get one this year, would be a change in policy by the Federal Reserve. And I look at global inflation and I see a bifurcation between relatively high domestic inflation within developed economies and relatively low global traded goods inflation, often deflationary. So, for example, car prices hardly moved at all. Most technology prices have been falling. And it's against that backcloth, I think the pricing in Asia is going to be really important this year in terms of gauging inflation, by extension, central bank policy. A whiff of policy change by Mr. Jerome Powell at the Federal Reserve would, I think, unhinge a large chunk of the bullish optimism towards both bonds and equities. And I'd be very interested in James A's view on emerging market debt, because if I'm correct that we are seeing positive pricing trends and price inflation in emerging Asia, does that present a buying opportunity still for emerging market debt, or has the boat left the harbour?
Yeah, I'm going to say something which has become a bit of a cliche in markets, which is to say that describing emerging markets as one big sort of homogenous pool actually doesn't get you very far. So I'll just distinguish a little bit. I think Asia has very attractive qualities at the particular stage of whatever we call a cycle these days. I think, Chinese local interest rates amongst the highest in the world, the Chinese currency, there are lots of reasons why one might expect that to be under appreciating pressure. The authorities seem relatively comfortable with that. And I think you can very easily make an attractive bull case for owning Chinese interest rate exposure. I myself am long Chinese government bonds currently. I think other markets there are higher quality in terms of bond markets, but there's less yield on offer. But Indonesia is another opportunity where you've got a relatively high yield, a relatively dovish central bank, and actually a central bank that seems comfortable with currency appreciation. I think still I have concerns over Latin America. They had a huge opportunity post the last Chinese commodity boom to fix the roof while the sun was shining. And in large part, certainly in the larger economies, they didn't really do that. And now they have huge fiscal challenges ahead. And so I'd be much more cautious on how, for example, Brazil can deal with a very large budget deficit, a very weak currency, a very high proportion of the population reliant on essentially government largesse to just get through the day, get through the week, and yet trying to deal with all of that in a virus-affected situation with a political leader who's less than fully predictable. So I think, broadly speaking, a lot of the value in hard currency emerging has gone now, but there are probably still some countries I'd be okay to take credit risk there. If we are going to see a weak dollar, we are going to see commodity prices up. I think some of the Middle Eastern names are still pretty attractive in terms of hard currency. In terms of local, I think you need to be very careful and selective about which economies and which central banks you expose yourself to, preferably those where there is still room and desire and willingness to cut interest rates.
But presumably a weakening dollar in emerging markets, it's with a debt could lead to sort of like increased inflation, won't it? Because it will give people the wealth effect.
Well, so the weakening dollar for me, this is it. This is the crux of the macro environment for 2021. Whether the dollar continues to weaken as it has, or whether it finds a base or indeed turns around, I think that will dictate to a large degree the rest of market moves. Predominantly speaking, a weaker dollar is good for emerging market FX, but there are a lot of countries where dramatic weakening in FX is not great because of the sort of balance of payments channel, but dramatic strength is not great either because a lot of these economies do rely on external demand. A weakening dollar is good for dollar borrowers in foreign currency. It's not good for the global economy, where really you don't have many current account deficit countries who are demanders for the world. You have a lot of mercantilist business models which rely heavily on keeping their exchange rates competitive. So if the dollar continues to fall, and actually if we start to see global investor hedging behavior react to that, because a lot of hedge ratios are low, that could become a precipitous decline and a really dramatic tightening of financial conditions for a lot of these global economies, including some of those in Asia. And we've started to see evidence of this. We've seen a number of central banks globally talking more strongly about their worries about their currency. And obviously just before Christmas, we even saw a very surprising move from the MBP, the Polish central bank, to basically be intervening directly in the FX market to try and deal with Polish zloty strength. I think that could be one of the crucial themes for this year, which will have dramatic impact across financial markets.
But didn't last, when we had the dollar weakening about 15 years ago, but I'm not an expert in the bond market, it was a sort of like party time because it was, everybody did the carry trade.
And that's it. But there is, unfortunately, there's not much carry left on the table. But broadly speaking, that's what the market is trying to engage in this year. I think that's why the consensus over the dollar is so strong, because to a large degree, you need a weaker dollar to justify the sort of pro-cyclical carry positions which the market is believing of in 2021. So it really cause and effect. I don't think a lot of the dollar weaker narratives stand up to a huge amount of scrutiny. The other thing that is worth noting, historical comparisons with previous dollar cycles, you had other cycles going on, particularly in G10. But the Fed would be the first to hike and the first to cut, but central banks would follow afterwards. What's happened this cycle is nobody's followed. Nobody's economy was actually strong enough to get anywhere close to monetary tightening. The UK had a couple of very feeble attempts, but the ECB is still stuck at -50. That dramatically changes the dollar dynamics. And really, I think that's telling you something about relative economic strength outside of the US and their ability to cope with the tightening of financial conditions via the external channel. So a fragile situation, in my opinion, with respect to the US dollar.
Right. Just on the equity side, Colin, when we talked about the sort of the mean reversion getting into sort of those COVID impacted the airlines, when would you see an opportunity to get into the cruise ships or the airlines, or is it best not just to stay well away from them? Because I did notice the bond guys who sort of like helped refinance Rolls-Royce and British Airways just recently, so they believe that there's value there. And what about the equity play?
I wouldn't hang about. I think the opportunity will present itself, long before the lockdown ends. I think in particular, the survivors have seen quite a bit of competition eliminated, and they're going to get some quite strong pricing, even if their capacity has been taken down. I think we're going to be in an environment where the survivors are going to be quite strong winners, particularly in hospitality, airlines. So I think that could happen really very quickly as the first quarter ends. And I think for investors, the opportunity is there in front of us now.
Yeah, with the flag carriers, though, on sort of the airlines, I've heard indications or sort of estimates that the business corporate travel is still going to be only sort of 50%, even post-COVID, because that's going to be a permanent change. And if you're a British Airways, then that's going to sort of dampen your business flights, isn't it? Business seats.
No, I agree. I think we see the opportunity in one or two of the other airlines rather than the flag carriers. So we're much more focused on stocks like Ryanair and WIZZ and those sort of models. They're going to come out of this pretty strongly. Yeah.
Okay. And then just sort of like coming to the sort of stock areas, but sort of like best sort of investment ideas. I don't really want to kick this one off, James B. What is sort of like what you're sort of like having a good look at going forward, whether it's a sector or whether it's stocks or whether it's bonds, or how do you sort of see good value for investors to have a good look at?
Well, I'm focused on free cash flow and the price that investors have to pay to participate in trend free cash flow. And I would observe that a lot of the medical diagnostics and ancillary services businesses suffered through COVID because elective operations were deferred as hospitals were used for COVID emergencies only. I think they will have a big bounce this year. To echo Colin's point in terms of discretionary spending, we're looking at companies like Compass Group as a company that could well bounce quite fast. And I'm certainly looking at the global banks. I still think there is more value in JP Morgan and Bank of America than the UK banks. But I do believe that it's too late now to participate in US housing stocks, but the UK housing market, I think from an equity perspective, still provides excellent opportunity.
Yeah. Anything is particularly on the healthcare diagnostics? That's something. So I mean, I've got some technology exposure and I've got some old economy exposure, but healthcare would be a perfect addition to my portfolio. I mean, Smith and Nephew diagnostics, elective procedure, but albeit they have sort of like relatively old technology, I think.
Well, I'm looking at a basket of names that are focused on areas like hip replacements, like
Stryker and people like that.
Therapies. So Diasorin is a name that I think that people should be looking at as a company that is well placed. Allergen is a company that clearly has plenty of legs to deliver excellent long-term returns. And I share Colin's view. You can't be too slow at engaging in these stories if you believe in the long-term fundamental underpinnings.
Yeah. What about you, James? In the fixed income space? I mean, I did notice, lad, we look at your portfolio. Don't own too much sovereign European debt for starters.
No, that's a market that I've loved to hate with mixed success, shall we say, over the years. Yeah, I definitely struggle to believe that there is an attractive asymmetry to owning Italian yields here. I understand the thesis that suggests the ECB is there and will continue to be there. But history has shown that actually if you have Italian idiosyncratic events, ECB policy is not sufficient to prevent there being spread widening. And underneath it all, I think you're still talking about a huge sclerosis across the Eurozone. So, I still favour being somewhat defensive this year, as I say, with respect to my more circumspect outlook, certainly for the first half of the year. So I still think there's value in US and Antipodean duration. I like hedging that with steepeners. I think if you can use derivatives, if you can find some additional steepness roll and carry in sort of belly forwards and then pay long ends against those, I think that's an attractive package to have. I think shorting inflation break-even markets in Europe and the UK. The UK is a position which I've had for many, many years and continues to be stubborn, I think partly because of positioning, but ultimately I don't think the inflation history or outlook justifies valuations where they are. In Europe, I think we know that, again, huge damage, huge output gaps, policy which struggles really to deal with the economic shock and merely deals with the market shock. I think European break-evens are already too rich here. And then if I was having to be invested in equities, I think the UK equity market is probably one of the most attractive. We've already talked about how there has been this kind of eschewing of UK assets because of the Brexit saga. I think a lot of that is in the price, and looking at the FTSE with a PE of less than 20 in a global comparison, that looks relatively attractive. But also you have a lot of commodity exposure, which should do well in a weak dollar environment. You have a lot of global exposure. I'm expecting sterling to give back some of its recent gains, and that should help support the FTSE as well. So that would be my three sort of ideas for the year.
Right. Because I remember 10 years ago, was it Bill Gross famously said from
nitroglycerin?
Yeah, and I think the 10-year yield was at 3% then, and it's got.
I think it was about 4, wasn't it?
It's about 4%, and it's gone down to what 0.2 at the moment, or 0.6, I think it is, or something like that. And then it's just impossible to sort of like predict the bottom in the bond market, but it just feels as though long term, at some point, this tight correlation between equities and bonds is going to break down. We're going to see, a difference. But when that happens, nobody knows, do we?
I mean, James, I think, has made the correct point already, which is to say that would be the shock for financial markets, is central banks being forced to change their outlook. The reason we have high equity markets and low bond yields concurrently is because it is those very same central bank policies which have driven those two asset classes in those directions. If the central bank were deemed to be constrained because of rising inflation, suddenly those dynamics change, and probably change quite dramatically given how ingrained investor reactions have become. So that's definitely a potential shock and one to look out for.
Yeah, and if you're on holding duration of 10 years, I mean, as a rule of thumb, is just sort of if interest rates go up by 1%, you sort of lose 10% of the capital, don't you, or something?
Well, yeah, probably about 8 in most bond markets.
About 8%, yeah. So which is just one of those.
Yeah, that's it. Unfortunately, the nature of bond maths is that the lower yields fall, the more duration you have for a given nominal amount of bond that you own. And that's great when the market is rallying, but that can go horribly wrong quite quickly if we do find a bear market. But again, similarly to 2018, the setup is such that can equity markets, can risk-facing markets cope with rapidly rising bond yields, or does that short circuit? James made a point previously about calculating where bond yields would be excluding central bank purchases, which I think is a completely valid approach to take. But what I would just throw in there is, where would the equity market be without those purchases from central banks? And therefore, where would bond yields be in relation to the equity market? And you'd probably find lower bond yields and lower equity prices.
Yeah, but you could see, I mean, there's been a huge difference, hasn't there, in the equity markets between the sort of the COVID impacted and the COVID favourable stocks, i.e. the ones with sort of like growth have just moonshotted, and they would likely to suffer in a higher interest rate environment. But you could find in a nominal inflation, the most beaten up areas come back strongly, so you get that huge rotation.
Yeah, and I think that's right. Unfortunately, the beat up names are now a tiny proportion of the indices in a lot of cases. So you have 5 stocks making up 25% of the S&P 500 and the entire energy sector making up 4%. So I do think that this rotation, sector rotation, seems like a valid investment thesis. My question is, can that continue in a in an equity bull market, or does the very notion of having to rotate sectors, and that means selling tech, does that weigh on the overall index? I think, again, an interesting and an open question for 2021.
Yeah. And what about you, Colin? Just sort of like wrapping up in terms of your favourite areas. You mentioned you were rotating a bit from the sort of the higher value plays into the sort of the more cyclical recovery stocks.
A bit of rotation, yes, but some of the COVID winners, a lot of those technology support services and other businesses, they're not all in technology. I think they've got some more legs. Businesses have realized they need resilience. So where they have been able to operate more online or data-based, I think they're going to invest to support that. So I think a lot more of the CapEx is going to come through in supporting business resilience. And I think ESG will remain a theme, the environmental, social governance, particularly environmental. I think we're going to see some government spend supporting that and direction encouraging that sector. So they've been winners 2020. I think there's still more legs in them for this year.
Yeah, because I see you've still got your OCDO and Ceres Power, haven't you, which has been doing very well.
Stocks like Ceres Power, ITM have been, truly wonders.
True winners. You've hit the ball out of the park. Actually, just before we finish, James, it'd be remiss of me not to ask you about the ESG side. I mean, how are you seeing that going forward? I mean, is this COVID just accelerated that whole move to sort of like, I don't know, cleaner energy and moving out of coal miners and the oil stocks?
Well, I think there are two rather different layers to ESG. There is the fundamental assessment that environmental, social and governance, extra financial risks and opportunities are a really important part of asset analysis, particularly in a world where data is so freely available, the opportunity to acquire an edge. I mean, I look back to the days where Colin had a slide rule and would have to go through paper reporting accounts to look for hidden numbers that no one else could see. Those numbers are now in plain view for everybody, and ESG, I think, is the new area for real added value. But I would sound also a second note of caution. There are an awful lot of people who now think that ESG is a marketing slogan. It's something that customers want to hear. And I would think that people really are going to have to sharpen up if they're not doing the right thing in order to demonstrate that they walk the walk rather than simply talk the talk.
Yeah. And just on the bond side, James, how important is ESG there? Because obviously you hear it always on the equity side, but I'll be interested to get your thoughts on whether, you're buying, I don't know, oil debt.
So, yeah, I mean, James makes a completely accurate point, which is that one needs to be careful that one isn't engaging in a marketing exercise. So ESG as financial risks, as risks that may present themselves in terms of the return on a given asset or the revenue streams which drive the return on a given asset. Essentially, that was something which has been going on in equity and credit analysis to some degree for many, many years. It's just, I think, been more formalized more recently. So that's been embedded into our credit research process for a number of years. And we've recently moved to embedding a similar sort of analysis into our sovereign analysis model as well. Our emerging colleagues have been doing that for a little bit longer. So it's definitely something which is impacting. It's worth noting, I think, that we do have some occasional nomenclature confusion between ESG as a set of risk factors versus ESG as a set of filters or something which looks more like socially responsible or impacting investing. And I think it's important to denote that the two are separate. So ESG as risk factors have to be considered by us in our research before being able to make that judgment as to whether an asset is attractive at the prevailing price. That doesn't preclude us from investing in certain types of asset or certain sectors. We have separate products for that, where our clients can either instruct us on a segregated basis or, buying into a pooled fund, they know that there are certain filters whereby we won't be funding tobacco manufacturers or
right.
ungreen energy production, those sorts of things. But definitely it's something that our clients are coming to us and asking about. I don't think it is a flash in the pan. I think it is a structural change to the asset management industry. Yeah. And it's absolutely something that we've been embracing.
And I think it's probably quite important, actually, just top level for investors. If you are going to go into sort of the oil stocks or into coal miners, it means that if the debt markets are tightening for those type of industries, and likewise the equities have been tightening for capital as well for some time, then the cost of capital for raising equity or for debt finance for those industries is going up, which means that conversely, then the return to shareholders is going to go down. So it's sort of like by default reduces the availability of fresh funds to expand those industries.
Yeah, the interesting thing is that if probably the best really historical analogy is probably the tobacco industry and what that went through as investors adjusted to the fact that here were these companies selling this carcinogenic product knowingly and openly and widely. And you get this interplay between the cost of capital, as you've described, but then the prevailing price of the assets themselves, that adjusts downwards to account for the fact that there is a changing demand. It becomes a very attractive proposition to investors who are willing to take on those risks or who are willing to fund those industries.
Albeit puts a ceiling, doesn't it, on the valuation multiple you apply, I guess.
It ends up being a cash cow, really. These are companies still throwing off huge revenue streams, but there is a discount on the price because they are deemed socially less desirable. But it means that for certain types of investors, it's a very attractive dividend or yield-paying stock.
Yeah, well, just again, top level, we talked about risks of probably the inflation being the biggest sort of like one out there going forward. But what about sort of like when you cash eye out 20 years ago, we had that huge amount of sort of, retail interest in the .com boom. Now we've got the Robin Hood effect, which has been estimated to sort of like take up 25% of daily trading on big days, and certainly in high sort of like momentum stocks such as Tesla, for NEO, for Bitcoin. Is there any risk at all to the markets if that sort of Robin Hood trade unwinds?
Yes, I think is the short answer. I think
how much is it sort of like, sort of stoking interest? Because I mean, when you see things like Snowflake on 100 times sales, you just got to wonder whether, it's just all out of, sort of reality.
Yeah, but again, we know the problem with valuing growth stocks is that the earnings projections are essentially a leap of faith. You're talking about businesses which have little or no revenue today, which are projected to have a lot more revenue tomorrow and huge amounts of revenue 10 years into the future. And very small changes in those projections can obviously impact today's price quite considerably. There is no way of objectively analysing or measuring that. It becomes a leap of faith. What concerns me from a market psychology perspective is the post hoc justification for increasingly crazy looking valuations on some of these stocks, particularly ones which have been around a lot longer and which have business models which are better tested and which have revenue streams which have been in place for a number of years. And we can see really how those revenue streams are changing. And yet still we have this almost J curve in projections into the future based on really little other than faith. And then it's margin. It's the fact that a lot of these retail participants are increasingly exposing themselves to equity markets with margin.
Yes.
And when that tends to happen, that doesn't tend to be a bullish signal going forward. So I do think it is a risk. I don't think it's a risk which people are unaware of, but potentially are not being as cognizant of the potential damage that an unwind there could do.
Yeah, I hate to say it, I'm actually quite looking forward to if there is an unwind. And the reason why is because my portfolio is positioned more on the value side. And if you do see an unwind, again, we've seen this movie before in 2000, when you had a huge pop in the internet stocks, then the beaten down old economy stocks had a roaring 2020. The banks, the home builders, sort of like the water utility, anything that had been sort of like sold off heavily came back strongly. So you could see actually a quite buoyant economy in the second half, a sort of a taking the heat out of the Robin Hood trade. And then that could accelerate, to your point, Colin, could accelerate that whole sort of rotation back into more value plays, because that money's got to go somewhere.
Paul, don't you think we should separate out the concept of buying an asset because we can observe the long-term free cash flow benefits from ownership as if we were owning a private company? And I have a lot of time for that. And I think that speaks to the value opportunity that you are describing. And I would separate out the cryptocurrencies, for example, that seem to me pure speculation, because they don't actually earn their investors anything. If you sit on a pile of cryptocurrency, they're not going to deliver you a free cash flow simply by being there. And this is an imbalance of supply and demand that, when it reverses, I think can be very savage indeed.
I don't know if anybody else has a view, but I have a totally agreeable view for that one. But Colin or James,
I think if we're perhaps looking for surprises, I'm not too sure whether the Robinhood traders are a big net effect in the market, and I'm sure they're constantly rotating. I'm not too sure they really make a lot of money to stay in business. I think we should keep in mind the possibility of tax changes, inheritance tax, gains tax, impacting AIM. There's a lot of potential. Even the big play in the US dollar. We've still to see a further round of elections that could determine the Senate and what kind of controls there are perhaps in the new president. So I think there's still quite a lot of politics and tax that could play out. And these are very hard for investors to second guess or predict.
Yeah, I mean, I would say to James B's point that the Bitcoin is worth about, I think it was sometime this morning, $650 billion, which would be by far and away the biggest FTSE company, probably 5 or 6 times bigger than the largest one. And it does seem I put a similar view out as you did, James, but I put it on social media over Christmas, and the amount of abuse I got for getting that one putting that one out there. But hey, we'll wait and see, I guess. But it does seem I guess what it comes down to, the only thing I would say, and I'm a massive skeptic of cryptocurrencies, is where the financial community starts legitimizing crypto. And we saw that with PayPal in October, saying it'll actually accept sort of Bitcoin. But I mean, all you need is a problem, one of the big exchanges to go belly up, and then the financial regulators. How do you view that one, James B?
Well, I see 2 issues. First of all, I would say that the cryptocurrencies are going to be legitimized by the central banks themselves, because central banks all want their own cryptocurrencies. The second issue is that what we have are people trying to buy into cryptocurrencies via exchange-traded funds and similar, creating an overhang of demand relative to the very finite supply. And that's what's squeezing prices. And people may want to abuse us for saying that there is no fundamental basis of value, but it's true. Bitcoin does not produce a free cash flow that is measurable or of benefit to shareholders over the long term. In contrast, if you have a value investment that is out of fashion at the moment, the price that you would be able to buy at will be depressed. But so long as the free cash flow is high and rising, eventually we will find an equilibration between price and value that puts you right.
Yeah, I did see a report on the counter argument that Citigroup were expecting Bitcoin to hit $250,000 over the next 5 years.
But we need to separate out predicting prices and understanding value.
Yes.
And I am saying that the cryptocurrency pricing is a bubble that is the product of excess demand over supply rather than economic underlying reason.
I totally agree, James. Yeah, price and value is a massive disconnect there. You're right. I mean, it doesn't seem to be any sort of cash generation.
Unfortunately, I think it's almost indicative of the market environment that has been created, which is, I completely agree with James. These are leaps of faith. These are, buying on the basis that you can sell to the greater fool theory. But unfortunately, that's what investment has largely been reduced to, because trying to deduce underlying value based on cash flows and revenue streams doesn't get you anywhere at all, because there is an 800-pound gorilla in the room who is constantly abusing asset prices in order to give the impression that everything is well when it really isn't. So unfortunately, that has become de rigueur for investors to merely consider the marginal narrative, the marginal news flow. So I think the use case, as you've already hinted at, for Bitcoin is where there should be a story about Bitcoin's true value. I'm not convinced by the use case at all. I don't think it deals with many of the things it claims to deal with from a use case perspective. Where I do think it's interesting, and again, it's still a leap of faith, is where can you attach yourself to a lifeboat from global fiat currency? There are very few things that you can buy that are not denominated in a global fiat currency, and therefore will not sink in value with that fiat currency if we find that central banks have gone too far, abused their privilege too much, and we have a significant destruction of fiat money. And maybe that's why we're seeing Bitcoin go parabolic at the moment, is because institutional investors, as you've described, are increasingly cognizant of the fact that it's a very small lifeboat and there are potentially a lot of people who want to get in.
So you're not lending, are you, to people with secured debt on Bitcoin at the moment?
Thankfully not. No, I mean, like you, I have been so skeptical throughout, because I just don't think the narrative stands up to much scrutiny.
Yeah.
Bitcoin itself is limited in supply, but the blockchain is open source, and therefore there can be a limitless supply of Bitcoin equivalents. Yeah. So there is no limit on the supply of cryptocurrency. It's just this one particular named cryptocurrency happens to have limited supply. Well, that really doesn't satisfy the necessary conditions, in my opinion. So I'm a big fan of owning precious metals today. I'm not a big fan of owning Bitcoin. Okay, well, thanks very much, James. I think we better call it a day there, but we'll wait and see. Obviously, the story will play out on the likes of Bitcoin and a lot of the sort of the high octane valuation stocks. But yeah, another fascinating session. So thanks very much, and wish you all the best for go forward.
Thank you so much.
Take care, guys.
Have fun. Goodbye.
Bye.